So let's start, first of all, with this new regional bank consolidation. It's the latest one. Give us your take from your point of view in Arkansas. What's causing this, and have we seen the end of it, or should we expect more?
Yeah, so I wish I could say that you see the end of it. I believe you'll probably see more. The dramatic raise in interest rates, that's having an impact on all banks, particularly community banks, particularly those that have securities that have portfolios that may be experiencing a significant amount of unrealized loss. But the particular merger between PacWest and the Bank of California, that made sense probably for them. It seems that that's going to be a stronger institution. You've seen their stock price take a little bump. And so hopefully that'll be better for folks in California, merging two good institutions together to make one stronger institution.
So we're seeing a fair amount of consolidation, I think it's fair to say, in banking right now. At the regional level, I'm not sure I've seen as much at the community level. Do you expect more consolidation? Is that a good thing or a bad thing?
Well, you know, it depends on how you look at it. So what we always think about is the folks who typically don't have access to capital, to banking services. Will they continue to have access? And you've seen, you know, over the last several years, tremendous consolidation in the banking space. And so at one time, you go back 20 years, where there were 15,000 banks. Now they're less than 4,500. And what typically happens is those who are least able to, bear the brunt of it, because rural communities, underserved minority communities, those are the communities that often lose their banks. So we're troubled when we see the consolidation, particularly if it means that people have to move further and further away from a bank and not have access to capital and credit, and to those services where you have a relationship that drives your ability to have capital.
The other big development of the week was the announcement of these proposed regulations coming out of the 3 federal bank regulators. Does that affect your bank at all, or is it just the big guys?
So the way they're structuring it right now, it's those banks that are $100 billion in assets and above, and we're at about $2.5 billion. Most community banks, you think about it at $10 billion and less. It's not going to affect us because right now that marks about $100 billion in assets and above.
You have a lot of relationships with some of those big banks, including as investors in Southern Bancorp. Insofar as they're feeling more pressure because they have to have more capital requirements, could it trickle down to you?
Well, I'm not seeing it right now. I can tell you that our relationships with the larger banks, JP Morgan Chase is a customer, as an investor, Bank of America is an investor, even some of your larger regionals like Cadence, like Regions, like Simmons Bank. Those banks, our partnerships remain very, very strong, and they're continuing to double down on their relationships with us. And we're trying to find ways to continue to work together to better serve our customers and to serve those who've often been left behind, left out of access to capital and the banking system.
So you fill a particular niche in the banking system with some of the people, small businesses, individuals, people who are perhaps not at the top of the socioeconomic strata, if I could put it that way, and sometimes underbanked people. Give us a sense of how the economy, the U.S. economy, looks to those people, your customers right now.
Yes, so we serve a lot of customers in the Arkansas-Mississippi Delta, one of the most economically challenged communities of all the United States. And that community has been suffering for a long time. And so when inflation hits them harder, right, so groceries, utilities, gas prices, those things hurt them worse. And so they're struggling. It is a challenge, particularly for our consumers. Now, our small business customers, they seem to be holding steady. You don't see them investing in their business as they have in the past. They're not taking out a lot of loans, but they're holding steady. But it's those small consumers who we make small consumer loans to. We're starting to see their past dues tick up just a little bit. It's not material to our asset quality, but we're noticing that just a little bit. And so I do worry about them as these inflation numbers, continue to. We're trying to get them under control. Of course, the Fed just raised rates, and that's an effort to get inflation under control. But it has a double-edged sword for them. So when you raise rates, their cost of borrowing goes up. But then if you don't get inflation under control, their money doesn't go as far. So it's a tough balance that we're trying to help them navigate.
What is the role of technology as technology develops in trying to serve your customers better, or more of your customers, frankly?
So it's very important, and we're investing heavily in technology. We have several apps that our bank has developed internally to reach customers. We have apps where we're really trying to train people how to save, to help them become savers. But also, I'm actually right now in a meeting with my team, and we're working on strategies, including technology, to bring our financial education services to the mobile device. Some people are much more comfortable using their mobile device than sitting across the table and talking to someone about their financial health. Going to one of our credit counselors or home buyer counselors and sitting down and talking with them and being very vulnerable about your financial situation. It's stressful. People don't want to talk about the mistakes they've made. So we're trying to see, can we bring some of our resources to a mobile device? Can we employ chatbots and other types of services where people can maybe perhaps their own home get the education necessary in an appropriate manner that actually allows them to make good use of that information and move themselves from being on or underbanked to being fully banked and having full access to the banking system.
The federal government response to the pandemic has injected a fair amount of fiscal stimulus in, and we still have some of that to come through, particularly when it comes to things like infrastructure, the CHIPS and Science Act. Are you seeing any of that money flow down to your customers?
Yeah, so we're starting to see that, and we'll hope we see more. In fact, in the Inflation Reduction Act, there's a $27 billion greenhouse gas reduction fund that's being created. And EPA is rolling out the rules right now and rolling out the competitions to really apply for those dollars. But they're trying to ensure that some of those dollars go to underserved communities, disadvantaged communities, because we know the impact of climate change doesn't affect everyone the same. Those communities that can least, often have the least amount of resources are hit harder by the impact of climate change. And so those dollars coming into those communities will not only help stimulate the economy, but also may provide, a buttress or a buffer from the impact of climate change on those underserved communities. That's one thing that we're seeing now. But we believe that the support from the Inflation Reduction Act, those infrastructure dollars, will have a positive impact on the community, including some of the rural and underserved communities that we serve.